Hello everyone, welcome to the Genesis Home Podcast, where we talk to experts in real estate, finance, business, community, and beyond, covering topics that are important to us. Let's listen in. Hi everyone, this is Rita Parker of the Genesis Home Podcast, and I'm here with
Jason Marcus from RoundPoint Mortgage, a subsidiary of Freedom Mortgage.
When did RoundPoint happen? Let's not go down. Anyway, this is actually a special episode today because so many people had questions for you on mortgages or what to do or certain scenarios. So you ready?
Yes, ma'am.
Okay. Question number 1. I am a student and I want to buy my first home. What advice do you have for college students or recent high school students going into college?
I mean, one of the things I always start with the youth of America is really understanding how credit works, especially credit cards and deferring of student loans. So a lot of times when it comes down to preparation to inevitably buy something, it's getting debt under control. So as much fun as it is when you walk onto these college campuses and sign up for those credit cards where it feels like free money, those things really do have a major impact in qualifying. So the best advice I can give somebody that's young is to not buy things that you don't have money to pay for. It's really the best way to do it. Inevitably, you need a 2-year work history to inevitably apply for a mortgage. So incrementally, you prepare yourself over the course of time, but it really starts with just trying to keep debt under control, getting a job where you're earning money and you can consistently show that job for 2 years. That'll set you on the path for inevitably being able to qualify. Eventually, you need to have a conversation with somebody like me, which will then set you in motion on the other things to prep you for it. It's a little bit too general of a question, unfortunately, but that's probably the best advice I can give on that.
So you did mention something really quick that I want to touch on. You did mention credit cards. Now, I was a college student, and yes, I took out some credit cards. What would be the best way to know how to utilize them effectively?
So what this is really getting a little bit into the nuts and bolts of qualifying and the way stuff works. So when it comes down to it, like you're basically getting hit with the minimum monthly payments on a credit report, which is affecting your buying power. So for every, just to give it a round number, it's not gonna be pinpoint accurate, but this is gonna be somewhat close. Every $50 in minimum payments that appear on a credit report is having about a $10,000 impact on somebody's buying power. So the more debt you accumulate, the less you're going to qualify for because it's having more of an impact on it's weighing against you. The thing that affects credit the most is limits versus balances. So you ideally want to make sure you keep credit card balances less than 50% of ideally 25%, but 50 is really where it starts to hurt. 50% of whatever the limit is. So if you have a $1,000 limit on a credit card, you don't want to carry over a balance of more than $500. If you can really get there, you want to get it to $250 or less. The best practice I was blessed with a mom that was all over me about this growing up. Your best practice is you buy things, you pay off that credit card at the end of the month. Carrying over balances is never, if you can avoid it, never a good idea because those things start to snowball on you. When you start to get into the point where you're paying minimum balances on things and you're accruing more interest than what that minimum balance is, you're snowballing out of control, and this is only going to get worse over the course of time. So focusing on eliminating debt and just making sure that you're paying those credit cards down or off on a monthly basis is going to keep your credit scores maximized, and it's going to make your buying power in the mortgage world far more achievable.
Okay. Wish I would have paid attention more in school. I mean, it went with my pocket.
Honestly, like when it comes down to it, it's this is one of those things. Like, plenty of people can take plenty of blame and plenty of things, and like, I'm not one of those people where I'm overly forgiving for people that just spend more than like they make, and like over like extend themselves because they want things. But when it comes down to youth and college students, I don't blame these guys. Like, they are set up in the system to fail, and like there's no courses that you get to take. There's no explanations that you get unless you just have an anal parent that like I did, that makes sure that they're monitoring these things and are all over it. You automatically hit that college campus and you're behind the eight ball, because these guys are literally out to get you, to put you in a position that to open up cards that they know you can't afford.
Correct. And believe it or not, my mom was actually pretty good with that. That by the time I got to my sophomore year, unless I had a job, I was not supposed to get one. So that was a great benefit. And we had to make a list of like needs and wants and what that credit card was going to be for. Like, if it was an emergency, then that's what that credit card was for. And it had to be these specific emergencies.
My recommendation to parents of college students is to have the bills for those credit cards always come to the parent. And obviously, they handle the payments of those credit cards and collect money from the kids. That's what my mom did. And
Ooh.
it never got to a point where it could get that out of control, because when your parents are monitoring it, they'll sit there and like basically either put the brakes on it or at least keep it up to date and on top of it, and then get into a position where they can start getting on your case for unnecessary spending on said credit card. And keeping your debt controlled and your credit scores high, they don't understand the impact of that. Just like riding a motorcycle when you're 20 years old without a helmet, you think you're indestructible and like life's never going to come and nip you. But inevitably, as we get older, we start to realize that life's a blessing. You can lose everything tomorrow, and you're not indestructible. So until that lesson gets learned, parent involvement usually is going to help with what we're talking about right here. Obviously, you want to give them space to breathe and grow. And I don't need me to be on the soapbox in regards to how to parent, but it was an effective way that at least I learned, which I'll pass on at least that story. So for any of our listeners are sitting there trying to figure out how to handle that part of college kids' finances, like, that's my recommendation.
We can sit on this one topic for a very long time, but I want to move on to question number 2. So you ready?
Yes, ma'am.
Okay. Question number 2. What should I look for in a lender or finance institution? I want to buy, but it feels like there are too many options.
One of the things that wound up occurring when Dodd-Frank, which was government intervention in how the banking system was working, they really did level the playing field. So from institution to institution, you're not going to see a drastic difference in regards to rates or costs. Like, you'll see a difference, but I mean, it's so marginal that when it comes down to it, my recommendation to people always comes down to having a discussion with several people, finding the person that's going to educate you the best. There's always checks and balances, and with the internet and availability to information, even though it may seem overwhelming to a person because they're not in it, you start to kind of get to the point where when you're comparing apples to apples, the service aspect of this stuff becomes so much more important than the nickels and dimes you think you're going to have to sit there and focus on. It is literally almost impossible. knows what they're doing and what they're talking about. So like
Okay.
if you're sitting there and talking to several people, one versus the other, you're going to get a better feel from one or the other. And I usually tell people find somebody that you're and go with your a little bit more of your gut in that scenario. But mostly I tell people make sure it's coming, your referral to that particular bank is coming from a trusted source and maybe somebody that has already done business with this particular bank or person, and like try to get a recommendation. If you're sitting there and walking into your local branch, there's no vested interest for them to sit there and take care of you in the same way that somebody that was referred would take care of you. So if you, Rita, are referring me, I not only, just because I'm a decent human being, want to service and take care of the client and do the best to educate them. I have a vested interest in this, because if I do a bad job, I lose somebody like yourself who's my referral partner and I gain no business. The person that's sitting in a Citibank or a Chase, no offense to these guys, they drop the ball on you. Your complaints online isn't taking down Chase. They're not losing anybody. They're waiting for the next person to walk in that door. So that's my best recommendation, is always take a referral from somebody and test these people out. You usually are going to be right when you're speaking to somebody, when they're answering your questions. If you're sitting there and asking a load of questions and this person can't answer any of your questions, this isn't really all that complicated. You should probably be looking for somebody else potentially to be more helpful.
So, really quick question, and this is just, you said something about the importance of like asking questions in referral base. One of the topics that's very common, at least between our industries, is will actually be about underwriting.
Okay.
What is an underwriting, and why is that important when it comes to looking for, a good mortgage company or finance institution?
The underwriter is making the lending decision for the bank. So the underwriters obviously are a huge piece of this. And what they wind up doing is they're the ones that issue the mortgage commitments, and they're the ones that are reviewing the files that I initially take upon application. I prep and give to my processor, who then prepares that file for an underwriter to review it. They're asking all the questions, and they're basically wanting to get as much information as possible to satisfy them that this client doesn't have any hidden liabilities, that they're a good candidate to lend to, and inevitably they're the ones that issue the approvals and tell us anything that we need to close the file. So they are the most important piece of this when it comes down to getting these things done. Now, most of these things that they're reviewing are pretty black and white when it comes down to income or the assets or the deposits, but there is plenty of stuff that plays into that gray area, that between the rules that are set by Fannie Mae and Freddie Mac, who are the biggest investors on Wall Street buying mortgages, they're trying to basically keep themselves in a position where they're satisfying their own interpretations of the rules and pretty much coming up with what they feel Fannie and Freddie's interpretation of these rules are going to be. So you got to kind of understand the process before you can really understand what the connection is here. After most banks originate and close mortgages and then they're sold to Fannie Mae or Freddie Mac, we close these loans and then have around 30 days to get it to Fannie Mae and Freddie for them to basically reimburse us back the money that we funded at the closing. So when that winds up occurring, they're reviewing the file. Now, my underwriters obviously have experience, so they know in most cases what Fannie and Freddie are looking for. Plus, if there's things that are up in the air, they do have access to contacting them to get their interpretation, so that way we know we're getting it right. But the banks, and a lot of times when we're going through these processes, wind up people come back to me and they're like, we don't understand why an underwriter's asking for this, or what's the importance of writing these letters or things of that nature. And a lot of it has to do with an underwriter understanding that there's not going to be a person standing next to the Fannie or Freddie who's ever reviewing this file and making the decision to reimburse the bank back for the money that was laid out for this closing. They understand that they have to prepare this file in a manner where there's nobody there to answer questions. So it has to be kind of airtight. And that's what the underwriter is prepping the client and myself and the processor for. And that's why they're asking these questions and to provide these documents. So to answer your question, an underwriter is huge in this process, and they are making the lending decision. So we need to satisfy them, which therefore satisfies, hopefully, Fannie and Freddie.
Got it. All right. That was good. Thanks,
yeah, sorry
Jason.
for the long-winded explanation. I mean, this is getting really into the nuts and bolts of how the side of mortgages work. So it's like, I hope I was able to explain that articulately enough so that way our listeners could really wrap their heads around that portion of the process.
It does, because it's always an important part to mention, especially when you're talking about mortgages, because there are some that that's not a common question, but it needs to be discussed, if that makes any sense.
Yeah, of course.
Okay. All right. Next question. I am a parent or legal guardian and I want to help my child get a home. What is the norm or recommendations you have to help us? Now, this is more about, I don't want my kid to I don't want my child to go to the dorms. I want their first property to be something that they can nurture or things like that. So, or, they want to help them buy their first home, which is very common, in not so much in the city, but largely the state and some other parts of the country. So what advice would you have for parents or caregivers to help them with
There's
the next
two different ways to do it. So it's like you can literally either gift them money to contribute to the down payment, to closing costs on that portion of it, or you can be a non-occupying co-borrower on the note itself. Now, the non-occupying co-borrower portion of it is a little more dangerous. Like, to me, it's always advantageous if there's a way to help your child. The best way is to just give a contribution to it and not be involved in it versus co-signing and then being liable for any negative repercussions if that loan isn't paid for on time. Because when you're co-signing for something, and this happens unfortunately too often, when you co-sign for somebody and then they're late on their mortgage, that's directly affecting you. So like a lot of times you wouldn't even know that was happening. If I had a nickel for every time I ran a credit report and it's like, hey, you had lates on this mortgage and the person on the other side of that phone wasn't aware that was happening, I'd be a pretty wealthy man just in that alone. Unfortunately, that happens a lot. So it's like you got to be super careful in regards to co-signing and just monitoring to make sure that things are fine, because people get embarrassed. Like all of a sudden you're in over your head, and a lot of times you kick the can down the road and you're not telling the people that this is affecting, that this is happening until it's too late. We've seen that in a myriad of different things throughout life and in different families and experiences. So you can help your child by co-signing on these loans, which is going to help them qualify for a bigger and better property. But keep in mind, it still comes down to the point, unless you plan on helping them contribute to the mortgage on a monthly basis, that person needs to qualify to be able to afford that mortgage itself. So if I'm sitting there and I'm trying to qualify your son, and your son can only afford a $200,000 house, but then you qualify or co-sign for him and then put him into a $400,000 house, it's not going to take a rocket scientist to realize that chances are he's inevitably, even if he can somehow scrap to afford that payment in the short term, long term, this could very much be a problem.
Okay. So it's really just, so basically what you're saying is that the two solid, one of the options will be like an investor, so to speak, and just contributing to that to that home as a down payment or something,
Correct.
or becoming a co-signer.
Co-signer, correct.
Wow, that's interesting.
Yeah, those are your best options. Those are really your only options when it comes down to trying to help them.
Okay, ready for number 4?
Please.
What is a bridge loan, and under what circumstances would a bridge loan be effective or appropriate? And I'm adding on to this. Why should they consider a bridge loan, and why shouldn't they?
I think they shouldn't consider a bridge loan because I don't even know who even offers them anymore. They were pretty disastrous. So a bridge loan was for the person that owned a house that wanted to buy another house and try to close on the purchase of the new house before closing on the old house. So there were loans out there that bridged the equity in that house for the new house, assuming that the old house was going to close. Well, guess what? Too many situations arose where that first house that they were selling never closed, turned into an absolute nightmare. The only real way that I'm aware of it, and I'm not such a of the mindset where I believe I know everything under the sun. So could there be a place to get a bridge loan that exists out there? Yes, it's possible. I'm just not aware of it. And most of the resources that did that have been way out of that game for a long time. So I don't want to tell our listeners that it's impossible, but it's most likely unlikely that they're going to find it from any sort of reputable institution. The only way to really bridge now is utilizing home equity lines of credit, where you have a home equity line of credit that you open up at least 4 months in advance, so that way you don't get penalized for opening and shutting it too fast. Never a good idea necessarily if you are planning on selling that house to tell the home equity line folks that you're planning on selling, because they're probably going to reject you because they understand that they're really not going to earn money and you are creating a bridge. But that's usually the smartest thing to do is open up a home equity line as large as possible, so that way you can write a check out of that to bridge to the next property. But mind you, you need to be able to qualify on both sides, meaning your existing mortgage, now your home equity line, and the new mortgage. So in our markets especially, it's most of the time unlikely that a person, or in my experience, if I'm qualifying people, the percentage of people that are able to qualify to hold all of those at one time is very limited. So doing bridge, like trying to create a bridge situation, usually isn't going to wind up working out for you. Most of the time, it's trying to time the sell and buy to happen within a day of each other, within the same day. That's usually the what's going to result is the best option. The bridge option is really a limited space for you to sit there and figure out how to make work.
What I find interesting is that you mentioned the equity line as opposed to, and I know you have your issues with these, but kind of like a reverse mortgage.
Well, the reverse mortgage is a whole separate entity. Reverse mortgage is for those that are over the age of 65 that have equity in their house and can't afford to pay the mortgage. So, or don't want to have a monthly liability for the mortgage. So that kind of does a very different thing. The bridge is really for somebody who's buying a property and trying to sell a property, but hasn't been able to sell it yet.
Got it. All right. Doing pretty good here. Number 5, and this is specifically for you. How does one become a mortgage officer or broker? I have a background in finance, but I don't know where to start.
Start by running the other direction. It's interesting. Like this particular industry, I'm not to discourage people, but you have to have a whole lot of patience and understand that most of your job is being a psychologist as opposed to like the numbers or the finance side of it. So if you're one of those folks that like have a whole lot of tough skin and a whole lot of patience and are really super good at multitasking, then this could be an avenue for you. But it's certainly it's pros and cons with it. But to answer the question directly, the first thing that you would need to do is you reach out to somebody like myself, and we basically onboard you, interview you, like to see if you're a good fit for this, just kind of prep you for how this is going to go. And then basically we first and foremost take you on. So that way you can start learning all of these processes. And then inevitably, you're going to need to get licensed in whatever states you want to do business in and get your federal licensing also. So it is going to take time and effort. And different banks do it in a different manner. So everybody's a little bit different in regards to how they're going to wind up training people. For somebody like me, it's like somebody lit a huge fire and threw me into the middle of it and said, good luck getting out of this guy. I made my way out, but it was a lot of questions. It was a lot of time. And unfortunately, the banking world, which I've been preaching for a long time, and I still can't even understand it. Banks want to hire seasoned veteran loan officers to originate loans. So in any place that I've worked thus far, it seems like the average age of a loan officer is somewhere in the mid 50s. I keep telling bank after bank, and I've been telling these guys this for years, it's like inevitably, I don't know who you think is going to wind up writing loans for you guys in 2030 and 2040, but you're not bringing any youth into this industry, because I can tell you this firsthand, nobody in college or in like high school ever dreams to be a loan originator. It's nobody's dream. Everybody inevitably falls into this just from like they have their mom that works like mine did for bank attorneys, or my sister's an underwriter, or, you know, my cousin is a real estate agent. And then inevitably, oh, mortgages might be a good thing for you, but nobody aspires to be in mortgaging. So there isn't a huge influx of people getting into it, and you're sitting there just like in the insurance world. You need to get tested and you need to pass federal and state tests to get into this and get sponsored by a bank. So it is a process. And the hardest thing that I see for new loan officers is when they do get into these banks is finding people that actually can train them, because most people in loan or doing mortgages are originating. So it's like if I'm sitting there trying to originate, it makes it super difficult for me to train somebody at the same time I'm trying to originate. I've been fortunate in regards to coming up with a system, and I've been successfully training loan officers, but it's only because I do it at a very small, slow pace. I won't try to train 10 people at a time. I'll train 1 or 2 people at a time. So that way I can give my undivided attention and really help them through this part of the process, and then inevitably teach them how to fish to a degree where they can fish on their own. But it really always starts with just having a connection with somebody like myself or somebody in a banking institution that takes on loan officers and can train them firsthand. But buyer beware.
Okay, so follow-up question. I know there's a difference, but what is the difference between a mortgage officer, broker, and I want to say originator, but I think they overlap somehow.
So when you work for a bank, or if you work for a bank or a mortgage banker, you're basically like whatever your title is, loan officer, senior loan originator, that you're doing the same job. It doesn't matter. That's just titles. At the end of the day, you're originating mortgages for a lending institution. You can, however, inevitably, just like on the real estate side, you can be a real estate agent, but then go and take further training and testing to become a real estate broker, meaning that you can really own your own shop. So a mortgage broker can basically go out there, or an originator like me that doesn't want to work for a lending institution anymore can go out, open up their own brokerage, and start originating mortgages. Now, they cannot issue pre-approvals. They can only issue pre-qualifications because the word approval is only tied to banks and underwriters that can issue such and use such verbiage. So sometimes you'll sit there, the brokers will issue pre-qualifications because they're not allowed to issue pre-approvals. And they themselves will sit there and place mortgages with multiple investors. So they have more of a cross section in regards to choices to be able to make in regards to where that mortgage is going to eventually end up. But they do play sort of a middleman role in this whole thing. But once the way that the industry has kind of morphed, you don't really have a disadvantage of being a broker. You're not overcharged by the broker as that middleman to like where you're getting a worse deal by utilizing a broker. It can be advantageous if that broker is really good in regards to servicing and they have a little bit more control over price because they're their own boss. But at the end of the day, you're not going to, once again, like it really just comes down to the quality of the originator / broker you're utilizing. You're going to find terrible mortgage brokers. You're going to find exceptional mortgage brokers. You're going to find incredible loan officers. You're going to find terrible loan officers. It's like there's no rhyme or reason other than work ethic and competence on what or who is going to wind up being a better route for you in dealing with this, from my experience.
Okay. That's good to know. I'm learning a lot from you.
Most people do. Pretty good at this stuff sometimes.
This is one I feel like you and I are going to have a bit of a long conversation on, and this is the one that is incredibly important to me. What is the real difference between an FHA and a conventional loan?
FHA is a glorified mortgage insurance company. So the Fed set this up to help people with not so perfect credit and not so much money to be able to qualify for mortgages. Now, what's interesting is over the course of time is conventional has become a lot more competitive with the way that FHA is. Where I remember starting and like you couldn't do necessarily, with the exception of, let's say, like the state type loans like Sony May, you couldn't do a conventional loan with 3% down, which now you can do it with 3% down. Because a lot of times when it comes down to conventional versus FHA, because they're a glorified mortgage insurance company, basically, what they're doing is they're collecting an upfront insurance and a monthly insurance, assuming that 1 out of every 5th loan of theirs is going to default. And then when that defaults, the insurances kick in to basically cover the mortgage up until that property gets foreclosed on and resold. So all through HUD. So basically, like for banks, FHA is super protective of what their mortgage in this case, because they know that, okay, if everything goes sideways, there's something to step in and really take care of this. And it gives it's safety for the bank. They also make probably more money on those types of loans, so it's really a win-win for them, in their opinion. And at the end of the day, it's protection. For the client, it serves a good purpose. I mean, the rates are usually really competitive, even for those lower credit scored people. The mortgage insurance doesn't fluctuate. It's based on a set percentage. So when it comes down to if you put 3.5% down or 5%, it is a good loan. But for the consumer, the mortgage insurance is for the life of the loan, meaning that inevitably, if they're going to hold the house long term, they're going to want to refinance into a conventional loan because they are going to inevitably want to drop the monthly mortgage insurance. Now, conventional, they're more driven where the rates and the mortgage insurance are directly tied to the credit scores. And unlike FHA, where you might have a little bit of a differentiation on like super low credit scores versus, mid-level credit scores, where you might see an adjustment on something like that from certain lenders. But generally speaking, you don't see a large cross-section of a variation in rates on the FHA programs, where conventional you definitely do. Like conventional, you might, depending on what you're putting down, that's going to have a bearing on how much the mortgage insurance is going to wind up being. And of course, your credit score has a major impact on all this stuff. So a lot of times I'm sitting there and comparing conventional to FHA on a lot of different loans. But anytime I'm sitting there and I'm at that probably 680 threshold in regards to the credit score, most of the time it becomes pretty clear cut. If you're at 680, under 680, and you're putting down less than 5%, most of the time, like, it's usually going to be more advantageous to go FHA than go conventional. And the inverse applies on the other side, where a lot of times when you're over 680 and you're putting like more than 3% down on a conventional, the numbers will work out where the mortgage insurance and the interest rates are comparable enough to FHA that it makes sense, even if it costs you a little bit more on those monthly payments, to go conventional, knowing inevitably that mortgage insurance is going to drop. There are a couple of like asterisks that go next to this. So for argument's sake, if you're putting down 10% on an FHA, instead of for the life of the loan, it'll be 11 years that the mortgage insurance is there. There's little things like that may have an impact on the decision making. But most of the time, for most originators like myself, it's pretty clear cut on which direction makes the most amount of sense for a client when you have a decent idea of long-term and short-term housing planning for that particular property. If I get a guy that's putting 3.5% down on and he has a 670 credit score and he's telling me he's going to move in 5 to 7 years, it is a slam dunk FHA deal. If I get on the inverse side of it, if I have a guy that is sitting there, he has a 720 credit score and he's putting down 5%, staying in this house for at least 10 to 20 years, no brainer. You go conventional. Each of these options should always be presented to you. It always makes sense, in my opinion, to do whatever it takes to get into a conventional mortgage versus an FHA. But there's still a reason why probably 25 to 30% of people need FHA loans. It's like it does serve a purpose, and a lot of times it makes a whole lot of sense.
The interesting thing is, and I really want to mention this really quick before I go on to our last question, is that when you're in real estate, people ask questions about, I want to buy my first home, I want to do this, but I don't have certain requirements. I always tell them, you don't know what you have until you ask. So basically, you don't know you could be surprised what you have in your arsenal with the right people letting you know. How about, you mentioned the credit score. Most people freak out over a 680 or a 620, but you don't know what that means. That doesn't mean that you're bad. It just means that there's other factors at play here. So what you're mentioning is how versatile or, not complicated, but how complex the system is or the process is when it comes to becoming a homeowner or getting out a mortgage or a loan.
Yeah, I mean, it's one of those things where when you know it, you know it. Mm-hmm. So somebody like me who's been doing this now over 20 years, it's so second nature to me. So it's so important to be articulate in explaining this stuff. when you're dealing with people that know what they're doing, just like anything, like you sit there and you hear a knocking noise in your car, you take it to the mechanic that you trust. He knows exactly what's wrong with it. It helps now that they could have that little code reader tell them. But at the end of the day, you know that this is going to wind up getting fixed. You're going to understand it and you can move forward with it. The unsettling part is always the listening to the knocking and not knowing what the expectation is going to be. Like when you actually know what it is, what it costs, and how it's going to get rectified, like that anxiety is lifted. Same thing on my side. Like, even though when you guys are listening to me talk about this, you're like, wow, that guy knows a lot and it seems crazy complicated. Start breaking it down to its simplest forms. It's really not that crazy. It's just a matter of, there's a lot to understand, but it's not anything that's all that complex. I'm not using medical terms that you guys can't wrap your heads around. You know, like most of this is simple third grade math. It's very, a lot of it's black and white. And, you know, we're talking about numbers and money and figures. And like, there's always a reason for everything. And there's an explanation for everything. There's not an unknown. It's not like, oh my gosh, I went to the doctor and he can't figure out why I have this thumping going on in my chest. It's like, I can tell you why your credit's bad. I could tell you like how much money you need. There's always a reason and an explanation. You guys might not love the answer, and a lot of times it might be antiquated with the logic in the banking world, but it's pretty easy when it comes down to getting answers for things. There's not much that is left to the unknown.
Okay. So, final question. Ready?
Shoot.
All right. I'm renting with goals to own a home. Any advice for a smooth transition that doesn't break the bank? This question came from a lot of questions or variations of this question came largely from the tri-state area. And for those who are not familiar with the tri-state area, that is New York, New Jersey, and Connecticut, which are incredibly expensive. I am not hiding that. They are not cheap.
It's preparation. If you're a renter, it's like, instead of like making the decision, I want to go buy 45 days before your lease is about to expire, start looking into this after you sign your year lease, because you know that it's coming. Like, there's not one person I've ever seen. Well, I guess that's untrue. There are people for some reason that just only want to rent, which is fine. But most people have aspirations of owning. So inevitably, like, it's once again preparation and coming up with a game plan that can inevitably be accomplished. So if I'm sitting there as a renter and I just signed a lease and I know that I want to buy something when this lease is done, you talk to Jay Marcus so that way you can formulate a game plan, know where you qualify, know how to like maximize your credit, know how much money you need, know what type of payments are going to work for you, know what type of property is going to make sense. And as long as you have your options set in front of you, not that hard. It's all you're doing is trying to accomplish and reach and hit those goals. So if I'm sitting there doing the math and I'm like, okay, right now you have $15,000 in the bank and you're going to need 30 for the specific transaction you're inevitably trying to accomplish, and your budget is based on a $3,000 monthly payment where you feel comfortable, I'm going to figure out, A, if you can qualify for that $3,000. You might, I come across people that tell me they want to be at $3,000 and can qualify for $4,000. So it's like I sit there and I'll give them the insight where it's like, this is what you need to, or this is what you should be targeting in regards to out-of-pocket costs and monthly payments to hit that $3,000. And then I'll give them the sliding scale. But if you get every $10,000 you go up, assume $50 more on the payment, and that might change them to their thinking of, you know what, 3,000 is cool, but for what I'm looking for, it's probably going to be closer to 3,500, and start preparing for that. Because when you don't know anything about anything, you're just coming up with just what you're doing based on your budget. So you're like, oh, well, I can afford $3,000 a month because I've been paying $2,000 a month in rent and saving about $1,000 a month. So $3,000 seems right. It's like, okay, cool. But a lot of times the prices in the market, like you were just open this part with, could be a lot higher than anticipated. And then that's my job to sit there and talk this through with you, structure a budget, and really delve into the fact if you can afford this. I'm all about suitability over eligibility. So just because you can afford it doesn't make it a good idea. Everybody's different. Some people have, the person that's helping with the mortgage that I'm not seeing any documentation from. There's a lot of people that are on fixed incomes where I know that if we stretch them, we're going to wind up choking them out. So like when I'm always going to lean towards conservative approach and explain to people where I believe that line in the sand gets drawn on a monthly budget and to prepare them right. But back to the renting part of it, renting, as we know, is just paying somebody else's mortgage and adding to equity of that property. It's always going to be better to buy. There's obviously positive tax implications that are going to wind up with income tax when it comes down to writing off the interest on these things. So it's very, very rare that I'm going to ever tell somebody renting's a better idea than buying, but preparation to buying, super important. Give yourself plenty of time, figure it out, get your options in front of you, and then implement the game plan we figure out.
There's so much to unpack, and I know we can't all unpack it in one episode. So obviously you are coming back. I
am so coming back. So never a worry there.
You're kind of like the way everyone's describing you from the last episode is like you're like the Mr. Miyagi of mortgages. So they're going, I was in Chase for like 45 minutes and I listened to one thing from him and I get part of it. It makes sense ish. So like the response, you definitely have to come back because we have so many questions and there's so much that we really need to discuss. So, but thank you so much again, Jason.
My
You
absolute
are
pleasure.
awesome.
Yeah, keep giving us these questions and we'll keep knocking these out. And like, so important. Knowledge is everything.
So, but today we are going to end just a little bit early because,
it's money to be made.
Pretty much. So I'll see everyone next time and we'll talk to everyone next time. And I'll talk to you later, Jason.
All right. Best and have a great weekend.
All right. Bye, guys.
Take care.